Hello and welcome to another exciting episode of Finance Footnotes, where we dig one or two layers deeper into the minutia, into the footnotes, if you will, to help you achieve better risk-adjusted returns, aka more money, aka better lifestyle. So that's what we're here to do today. I'm your host, Brent Stransky, joined by my friend and colleague, Zach Miner. Today, we're going to go into some different topics. I'm going to talk a little bit about where we are in the marketplace today. Secondly, I'm going to talk a little bit about, or further talk about this topic, some things we're concerned about on the horizon for the mid and longer terms. End on a point of optimism. And finally, Zach, what do you think? We're 1 month past the election. I think it's okay to start talking a little bit about politics. I've got a couple of ideas there for everyone there at home. Zach, what do you think? What's going on for you today?
Yeah, I'm just going to highlight a couple economic indicators, and then we've talked about artificial intelligence and how that's going to impact businesses. But I have a couple kind of concrete examples of how it is already affecting some of the biggest businesses in the country.
All right. Well, I haven't looked ahead in the notes here. I'm looking forward to learning along here with our friends and clients at home. Zach, did you have a chance to look through my slides yet?
I clicked through a bit.
Okay, well, I have a little snare in there for you, so I'm trying to lure you into a trap. Let's see if you go for it. I won't tell you what it is. But folks, here we are at home. Right now, I'm bringing up from the Wall Street Journal this morning, just looking at the three indexes, very near all-time highs. The markets have made more than 50 new all-time highs this year on the broad index, the S&P 500, and the indexes are all up at least 26% year to date. It's an astounding year following 2023, which is also a great year, which is following 2022, which is a pretty crappy year. So things look pretty good. We're at or near all-time highs on the indexes. December, typically a good month for markets. I also want to take a circle back to the CNN fear greed indicator. That's something we often look at here on Finance Footnotes. And you can get this for free any day going to CNN or just Google it. But last 2 weeks ago when we were together, it was firmly in the neutral sentiment camp. And then today, this morning, 57, kind of edging a little past neutral into the greed category, about a little less than we were a year ago, which was at 63. Just a litmus test. One point that's changed since then, Zach, I know you're asking. I can hear you kicking me under the table. This is my favorite indicator that's of the seven that the fear and greed index. We talked about it last week, but it's the put and call ratio. So right now it's signaling extreme greed. It's not that different from last 2 weeks ago when it was a neutral reading. But the point I want to highlight here is that what is the put call ratio? Well, it's just how many folks out there buying insurance, buying protection against their investment going down. Okay. And it's measured by how many puts insurance to how many calls, which are taking the other side of that bet. And you can see here that it's at about the lowest it's been in a year. Zach, what do you make of this? Anything important at all, or just worth glazing over?
Yeah, I mean, you can certainly kind of look at it as just a sentiment indicator, kind of where folks think that the next. And typically these options are shorter term, right? So you're looking kind of 6 months, 3, 6 months out. That it's almost like a capitulation indicator, right? That the bears are kind of giving up at this point, which is often a contraindicator. Once they finally give in and unhedge and go all long, that typically could be a contraindicator of where we have been going. So something to keep an eye on. But you can see that back in July it was similarly low, and that obviously did not portend any sort of downturn in the following 6 months. So
Yeah, and I've got a
take
really
it
great
take it
note
for what
about
it is,
that.
right?
Yeah, exactly. So this is just one of many, variables that we're watching here on Finance Footnotes. One of my personal favorites, but it's enough to get my ear up and question. People aren't that concerned about the volatility. It seems, at least from this one indicator. These are people putting their money on the ground, which is different from the next indicator, which is the sentiment survey from the American Association of Individual Investors, which you can also get for free. But they publish this every week. It's a poll. It's unscientific in nature, but they have a new kind of cool feature where they break it down by state, which you can check out on their website. And I wanted to highlight a couple of interesting things here. Since the euphoria, or more euphoric stance in the marketplace up to 3 weeks ago, early November, after the election, after the tensions had abated slightly, you can see the sentiment has decreased from about 50% bullish to about 37. And that's just a little less than the historical average of 37.5. So this chart is showing you green, bulls, gray, people that are neutral, that don't have an opinion, which is a surprisingly high 24%. And then the red there are folks that are bearish, think the market's going to go down in the next 6 months. So I wanted to highlight a point here. Another chart here from American Association of Individual Investors. Brent, what does it all mean? Well, this chart's pretty cool. It's a very busy chart, Zach. Sorry about that, folks who are watching at home. But what we're seeing here is the green on the top and the red on the bottom. You can see there's been a convergence. You can see that there's more bears now than there are bulls. And that's the first time, especially with this type of energy that we've had all year. There was a point back in April where this happened. And what does it mean? Well, once again, we're going to ask our friend and former colleague, Ryan Dietrich, who's the chief investment officer at Carson. And here he has a tweet here just from a couple of days ago. He says, it's the first time since April that this has happened. And what happened after that? Well, there was 5 months of record-breaking stock returns. So
Right.
maybe we shouldn't. Well done, Ryan. Maybe we shouldn't have actually taken any action based on this. It's just something to be aware of. We're not, we're investors for the long term. We're not trying to make knee-jerk reactions. Certainly not asking people to take any type of action based on this. But it's just something to be aware of. Okay,
And
so that's.
those kind of like sentiment indicators, and especially kind of the put call, I kind of like it more on the flip side when it's really showing an extreme bearish position as kind of
Mhm.
a potentially good buying opportunity, rather than the other way where kind of showing the opposite. Because as we've talked about plenty of times before, momentum and bear and bull markets do tend to continue to run. But a lot of times when folks are extremely bearish, that does tend to indicate a potential good buying opportunity. So I do like this. I think these are a little more powerful on the opposite side
What's
of
interesting
kind
to
of
me,
the
Zach, is that they're
ledger.
kind of signaling different things here. You've got the folks now. These
Yeah,
are now,
for sure.
this is like non-institutional investors for the American Association of Individual Investors. It's a mouthful, AAII, and they are saying, "Hey, we're getting more bearish." But then, if you look towards that put-call ratio, which is just the average over the last 5 trading days, you can see that institutional investors, people actually putting money on their bets,
Right.
they're signaling, not much fear out there. So we'll have to see what that means. In my experience, the put-call ratio is a bit more leading or telling, but we'll have to wait and see. As you said, no
Right.
perfect indicator exists at the moment. So switching gears, I just wanted to give a little bit of a litmus test to where we are, okay, based on the markets, based on the sentiment. And now I want to turn our attention to something that Zach and I talked about just 2 weeks ago, valuations. Okay, so I have a slight update here from the JP Morgan Guide to the Markets. We talked about this 2 weeks ago. It should look rather familiar. I'm just going to glancingly pass through. And you can see here that the forward earnings on the S&P 500 price to earnings is 22, and it's meaningfully higher than average, which is closer to the 30-year average. If I'm reading that correctly, 16.8. So we're 1.66 standard deviations above. In other words, very much above. Okay. What does that mean? Well, we talked last week that doesn't necessarily mean anything in the short and near term, but over longer periods of time, it could indicate more muted returns for stocks. Is that a fair synopsis, Zach?
Yeah, I mean, I think we did do a pretty long talk about this a couple weeks ago about the kind of changing nature, of the markets and how much stock you should put into it. But it is extended kind of by any measure, even if you do adjust for kind of recency of the kind of operating margins and profitability of the S&P over the last 10 years rather than the last 25, 30 years. It's still extended even above that. So it's certainly not a cheap market. And over the forward 5-year period, starting valuations do tend to matter.
We will have to wait and see. That was a great conversation. I personally find it valuable, and I hope you folks at home did as well. But it got me curious, and that's why I wanted to dip back into the subject again today. So, I saw a couple things on the say Twitter sphere. What can you say now? The exosphere? I don't know. On X, the X platform, you follow a lot of different, contrarian indicator and voices out there on that space, and it's a great platform for investors to kind of get a sense of people's opinion, right or wrong. But I saw some things out there, such as the French markets, stock markets have been flat over the last 10 years, or aka no returns at all.
Mhm.
South Korea has been in the market, Zach. Maybe you followed some of the news as of this morning. There's kind of a the president of South Korea kind of put in a what would you call that, a
Martial law.
martial law? Yeah. Wow. Okay. So a lot
and then
going on in
re-
the
and then
world.
rescinded it. Yeah, that was a strange political move
And I saw,
going
I don't know if
going
you
on
saw
over
that. I
there.
saw a tweet, a post that said of the last five prime ministers in the South Korea, like three have been assassinated, two have been put out of office forcefully. So it's been a pretty terrible job to to hold.
Yeah,
Um,
it's also, it's the 12th largest economy in the world, and a pretty important one geostrategically. So it's not great, for global economy, for the Korean, democratic government to be in kind of disarray like it is.
Yeah, it's and thanks for bringing that up. That it is the large economy. It kind of gets lumped in with emerging markets, which we talked about last week. So we don't need to repeat. We'll include a link in the notes to that previous podcast if you'd like to take a look. But it got me thinking about about the 10 largest economies in the world, and I want to compare them based on price to earnings ratio and asterisks. What does that mean? Essentially, that's how many years it would take a company at current earnings to buy back all of its stock, right? So the higher that is, the more years it would take to buy back, the higher the value, right? And that's what we mean when we say price to earnings valuations. So here on this chart, I have the S&P 500 on the top, and then I have 10 economies, roughly the 10 largest, not exactly. For example, Russia is not on this list, and nor should it be. But I digress. So what we see here is the price to earnings all the way on the right. We're seeing current price to earnings, forward earnings. You can see the S&P 500 at 22 times earnings. It's the highest on the list by far, and there's a lot of good reasons for that. Only point I'm making here is that if you look towards the other 10, going down India, Canada, Japan, Canada has a price to earnings of 16, Japan has 15, Germany 13, Europe, the continent, even slightly lower. Then have emerging markets ex China. Emerging markets ex China usually considered to be a pretty volatile investment over time, certainly more volatile than the S&P 500. At 12.7, China 10, and then what about these? I'm surprised, Zach. Mexico, would you believe, is at the bottom of the list, less than 10 price to earnings. Then South Korea at 8, and Brazil at, wow, bottom of the heap, 7.5.
Mhm.
Does any of this surprise you, or are you just this is what you were
Doesn't
expecting?
doesn't surprise me at all because it's cheap for a reason. And I do we we talked about this last week, that me personally, I think that the value is in the domestic U.S. economy. I think that if you go down this list, there's problems with every single one of them. Maybe Canada you can kind of put off to the side as kind of being within the kind of U.S. type adjacent markets. I mean, they're our largest trading partner. There's trillions of dollars of value being exchanged between these two economies. But they're at 16. They're not necessarily super cheap. But some of those other ones down there, I mean, they're cheap for a reason. And especially in Europe and Japan, when you start to look at the demographic situation, which we've talked about plenty of times, and the kind of dysfunctional nature of the Eurozone, where there's a significantly deteriorating economies that are kind of being funded by the better economies. And, I think that's partly why Germany is cheap, and also not delivering significant returns. So, I'm not surprised. I think that they are not necessarily, if you look at it, are they undervalued, right? That's the question. And I probably would say no. I think that they're probably appropriately valued because,
We'll have to dip back. We'll have our, what
yeah,
would that be? Probably our 200th episode in 10 years from now, as we
yeah,
kind of regroup. Here's what struck me as interesting. We're talking about valuations here. Of course, where's the innovation happening at? To your point, Zach, it's happening here,
exactly.
in parts of Europe and parts of Asia, select parts. But broadly speaking, in the U.S., it's fantastic.
There's
But what's
there,
really interesting,
there's very little innovation happening in Europe because the regulatory regime is choking it all off. Every AI company is either closing up shop or not even offering their tools in Europe because of the regulatory regime. That's a cautionary tale, I think. When you see some of these more aggressive regulatory bills that are being put forward in the U.S., especially the one that Gavin Newsom vetoed a couple months ago, or a month ago, in California, about regulating AI. Dangerous stuff for economies, and you're seeing the results of it in the
every
Eurozone.
week or even several weeks, the Eurozone is attacking a major U.S. technology firm for some
Yeah,
violation for billions of dollars. Um,
ridiculous.
Here, and that's a great point. The point I want to make here on this chart, and then we'll move on, folks. Thanks for bearing with me. Is that of these 11 names on here, I've got two red arrows. The first on the right is showing you what the price to earnings are. But then if you look to the second arrow, I'm looking at 10-year returns. Of course, this is not promising future returns, but it's interesting to me that almost exactly the higher the price to earnings ratio, the higher the 10-year return has been, which of course we should assume some type of correlation over time. But the bottom five have had, as you know, if we include inflation, have had negative returns
Right.
over the last 10 years. That's Brazil, South Korea, Mexico, China. Um, Amazing to me. So, possibly there are pockets of value out there, but it's cheap for a reason, like Zach said. China, for example, I think a lot of people talk about China, but it's been negative over the last 10 years and the last 5 years. And I think, there's no rule of law there. So anyway, have a discussion with your friendly financial advisors about more details.
China has really changed in the last 10 to 15 years. Where if you were having this conversation in the early 2010s, China was they had authoritarian leanings, but it was still a relatively capitalist economy, and there was a lot of space for companies to grow and to have foreign investment. Think of Alibaba and Tencent and some really really good companies that were growing and attracting foreign investment. It's not the case anymore. The
Yeah,
the
the boot
the
of the
communists
regulatory authority, it's
the
at the
the
neck of
communist
innovation.
yeah, the Communist Party has completely taken over, and it is really no longer a capitalist economy. It is a state-run economy, and that's why Alibaba trades at 8x or something like that. I mean,
Yeah.
it's extremely
Compared
depressed
to
based off
Amazon,
of
maybe around 30 folks. So,
yeah, based off of what it's doing, right? Based off of its sales and the potential there. But there's a reason for that. I mean, Jack Ma disappeared for months, because he
it's,
was
yeah.
critical of the regime, right? Like that's not something that is going to attract any foreign investment. So it's not surprising, and I don't think that that's going to change, in the near future.
Well, Zach, let me just puff you up a little bit like I often do. You're hitting the nail on the head. There's a great article in the Wall Street Journal this morning. It was talking about how a lot of folks, especially for their retirement funds and 401ks, for example, they go and end up going into balanced funds or target date funds. And these funds, depending on which one, have between 20 and 40% exposure to international markets, where you just heard Zach and I make a reasonable case why we are personally and professionally underweight international equities for our clients. And maybe you'd want to consider the same. But if you're blindly going to these target date funds, you may often have a 20 or 40% exposure to these markets that have really underperformed over the last 10 years. We'll have to wait and see what happens going forward. But, we're guessing that it could be more of the same. So you're hitting the nail on the head, my friend, according at least to that Wall Street Journal article as well. So moving ahead, I'm going to two slides about politics, folks. That's it. Just resetting the dynamic here a little bit, and then I'm going to end with a positive note and hand it over to my friend Zach. So the first thing I wanted to say here is the markets rallied last week. There've been a lot of news about elected President-elect Trump, making some unusual appointments, but one that really made the market happy was Scott Bessent. He's a well-known entity on Wall Street and received a pretty good critical appraise. And so I think that was a mature pick for what that's worth. But I wanted to point out that there's a great quote here, and Barron's did an article about him over the weekend. And this was in June. He was giving a economic discussion to a policy group. And he said, he's kind of comparing this as, for those who know, for the initiated, that would be the Abe had in Japan had a three arrows economic policy 10 years ago. And so mimicking that, Scott Bessent said, Trump's three arrows, this is before he was appointed, this is back in June, Trump's three arrows should include cutting the budget deficit to 3%, currently over 6% of GDP, achieving GDP growth of over 3%, okay, and producing 3 million barrels of oil a day. So three arrows there strategically. Despite what we think politically, the markets saw this as a mature and solid pick. Okay, so that's just a highlight I wanted to make there as a part of the run up here going forward. And the second thing I want to talk about, which of course is more controversial, is just the progressive nature of the tax policy in the U.S. There's been a lot of concerns about this, especially as there's a sunset coming at the end of 2025, which could affect higher income earners. So the Wall Street Journal over the weekend tried to put this in context. I want to share this with you. Which I kind of find interesting. To be in the top 1% of income earners in the country, you'd have to have an income of $661,000. That includes 1.5 million followers, filers, not followers. I don't think the IRS has any followers on Twitter. What do you think? Anywho, moving along. Average, they have this top 1% make 22% of all the income in the country, but they pay 40% of all the income tax. Okay. pretty interesting, almost double. Okay. If you're in the top 5%, you'd have to have income of over 262,000. That includes 6.2 million followers, 16% of all income, and 20% of income tax paid. This is interesting. Just two more points here, folks. Thanks for tagging along here. The top 25% of income earners all make over $100,000. Okay, so that's kind of the line of demarcation for six-figure income. That includes 23 million followers. And this is already starting to see some flow from those top filers. They get 20% of all income, pay only 15% of all income tax. So they are being progressively taken care of by the top 5%, 5 and 10%. And then the bottom 50% of filers, 77 million followers, they make 12% of income and only pay 3.7% of income tax. So the point I wanted to make about this, any thoughts on that, Zach?
It's a highly progressive system, and I think that gets lost a lot of times in translation of political punditry. But the top 1% pay 40% of the tax. I mean, what else do you want them to do? Especially if you live in one of the high tax states, California, New York, and you're a top 1% earner, you're paying probably 60% after you include state, local. I mean, where else is there really to go? We don't have and this is an opinion. So people have their opinions. I don't think we have a revenue problem, right? We have a spending problem, and figure out ways in order to reduce that. But
I think there's
not too much to. And
yeah,
so when
go on.
I was gonna say when politicians talk about raising revenue and raising taxes, the only place to go really is the kind of the median, right? It's the meat of the country. It's folks earning between 70 and 100,000. That's where most people are. That's where most of the money is, and that's where really the only place you could possibly raise revenue, because there's just not enough there's 1.5 million people that make in the top 1%. Like there's not enough money there, to take any more. So if you wanted to raise revenue significantly, you'd really have to go to the middle class.
I can't wait years from now when you're running for office and like all the people peel through all these podcasts and come up with this type of anyway, I think listen, folks, it's a complicated topic. I just want to take a deep breath and a step back. And the top 5% are paying 60% of the income. The snare I was trying to hook you with, which you didn't fall for, was that the Wall Street Journal. And I think some people would often say, well, that doesn't include the payroll taxes such as Medicare and Social Security. And once you pay those into the system, you'll see there's it does, well, they would say, but the Wall Street Journal in this opinion piece said, it doesn't, it modifies somewhat the progressivity of the tax code, but the overall picture does not change. So We'll have to see what happens. This is why I think we're talking about tariffs and consumption taxes. So we'll have to wait and see. So just a couple of things here to start tiptoeing our toes back into the political discussion. Let me finish with one positive slide here, and then we'll move on. So last week we highlighted a couple of points here as to why we could be optimistic. There's been a lot of momentum in the marketplace. One other that came from our friend Ryan Dietrich yesterday on Twitter at Carson Wealth was, hey, the markets are up over 5%. The S&P Broad Market Exchange is up over 5%. Typically a good sign. After 1 year after a 5% month gain or more, this is over the last 74 years, you can see on average higher 85% of the time with an average return of 13.5%. So I think there's a lot of momentum here. I mean, you don't see these, not bad. So I think there's plenty of reason to stay optimistic, folks, over at least the next 12 months and probably longer. We'll bring you more data points in the meantime, but this is definitely can't talk in platitudes such as that, but I believe that it's important to stay invested for the long term, especially over the next interim here. So with that said, I will turn it over to you, my friend. What do you have for us today?
I have a golden doodle. Doodle here for you.
Oh, cute.
We talked about politics, so here's a little cleanse.
How old is this little fella or lady?
He is 6 years old. His name's Scooby.
Scooby. What a clever name. Really showcasing your creative skills there, Zach.
Yeah. All right. So first, I want to take a look at the interest rate picture real quick. So we're looking at the 10-year U.S. Treasury going back until the mid 2023. You see it kind of hit that high September of last year, got just at 5%. And then we had a pretty decent spike after the election. Higher tariffs, higher inflation kind of led to a
Didn't it not
spike.
peak just at the election? It hasn't, isn't it down slightly since the election, like
No, it
20
definitely
bips or
is. Yeah.
something?
Yeah. So you've
Crazy.
had that. Yeah. So it got in the week after the election, it got almost a little above 4.5, kind of 4.45%. And folks were a little bit worried that we were going to kind of start trending back higher, but it's since pulled back significantly. And I'm not much of a chartist, but I do kind of look at higher highs, higher lower lows to kind of indicate just the trend. And you can kind of see on this chart that we did kind of stay under the prior peak that we hit back in May. So the downward trend in interest rates is still intact. And I think that's the main kind of point to look at here. And if you do kind of get back to that 100 week moving average there, that could get you to 4% by the first quarter of next year, which I think is a decent target. And that'll be good for mortgage rates. That'll be good for auto loan rates and credit card rates and things like that. So,
And the economy in
um,
general.
and the economy in general and stock prices
Yeah.
and kind of all those things. So, I
Yeah.
think we were a little worried there that rates were going to spike, and so far that we've kind of had a pullback. So, just something to keep in mind there.
If I can just add in here,
Yeah.
since we spoke last, I bought a newsletter. I only pay for information from one person. You get so much free stuff out there, other than like the Journal and the Barron's and other newspapers.
Hmm.
But his name is Jared Dillian, and something he says something really interesting, which no one is saying, right? No one's talking about 0% interest rates ever coming again, right? In fact, that would be the far opposite of what the consensus is saying. And he
Yeah.
said, it's not maybe as far-fetched as we think, and maybe it's more of a reality. If we do start to get some budget hawks in place, it will certainly put a foundation under interest rates concerns. We'd have a firmer footing. And he said it's not impossible that we see nominal inflation adjusted 0% 10-year returns at some point this presidency. Crazy stuff. Just putting an asterisk there. We'll see what happens.
Nominal or real? He was saying
Sorry,
real,
real.
right?
Yeah, real.
Inflation's
So
three.
yes,
Okay.
track to 2% inflation.
Right.
Interest 10-year gets back to
Because we
two and
had
a half.
real rates of negative, right? -2%
Mm-hmm.
after
Mm-hmm.
inflation kind of during the ZERP era. And I would be very, very, very surprised if we saw that if for the foreseeable future. There would have to be
Real and
some.
nominal. Yeah, I mean, or
No,
yeah,
no, nominal, right? I mean, you could get to real, right? If you have 2.5 inflation, which we've kind of been on the record that inflation I think will really be structurally higher, in the next 10 years, above 2%, 2.5, 3%. I wouldn't be surprised if that's where it ends up averaging. So look, if you get a 3.5, 3% treasury with 3% inflation, right? That's real zero. So I wouldn't be too surprised if we get to that kind of environment. I would be very surprised if we get to like literally zero
okay.
bound
Well, we're on the same page, and
nominal.
I
Yeah.
think though that either would be a surprise. I don't think the market's
Yeah.
pricing in,
No, it's
and
not. No.
we'll have to wait and see what happens. But
Yeah. No,
time will tell. We'll
yeah, that's interesting.
keep you posted.
This next one, just another way to look at kind of what you had posted before with the put call ratio. So this is U.S. stock futures, and this is more for asset managers, kind of professional investors, hedgers, and basically they took all the hedges off. It's kind of just looking at bear capitulation in another way, showing quite an extended positioning where there's really no hedging left in the markets. And that typically, has coincided with some not necessarily market tops, but market, consolidations. You can kind of look back at the other periods where, it kind of crossed that, that red line of kind of contracts on the right hand side, a million plus at futures contracts being on the long side of things. And there were a few periods where, kind of had some long-term consolidations, a few minor declines. So I do think it's just another way to look at kind of that put call type of ratio, just showing the positioning of folks is long, right? That's that's where the market looks at now. Future, you can see this is a very volatile indicator, and so it could be a situation that you're looking at all those first 11 months types of indicators, and that December is going to be good type of thing. And so all these asset managers are just positioning for end of year and trying to catch that, right? Because futures are leveraged. So if you get, upward, if you get a good December, the futures payoff will be leveraged to the index. So, could be some of that, and we'll see if this kind of resets, at the beginning of the year, but just something to look at.
Yes, we'll have to wait and see. I think it's, whenever all people on one side of the boat, you know,
Yeah,
it's
exactly.
a
Right,
reason
right.
to.
Yeah, that tends to tip. Yeah, for sure. And this next one, I always like looking at the TSA throughput just as a good economic kind of indicator. Like, what
Could
are
you tell
folks
us what the
doing?
TSA throughput is for folks at home?
Yeah, so it's just the number of people that go through TSA checkpoints, and it's
It's
essentially a
not as
proxy.
academic as it sounds. I mean, you could
It's,
you
but
can make
it's
anything sound academic. Just the
but I
folks
mean,
flying
yeah,
on the
but
holidays.
you can't fudge these numbers, right? It's the number of people going through TSA and getting on, right? So you can't like
Yeah.
there's a pretty easy indicator to interpret. It's like how many people are moving, across the country for holidays and vacations and business trips and all those different things. And it's kind of just a proxy for, how the public at large is kind of thinking about the economy, right? Are you flying places to do things? And you can see that 2024 has been a record year, significantly above 2019, the kind of pre-pandemic highs, and significantly above last year. But there was a little bit of a kind of late summer lull there, but picked back up for the Thanksgiving holiday,
It
and we
looks
had
like
a
it's all
record
well above
well above
the
record.
2019 and really intriguing to
Yeah,
watch this.
records.
Just colloquially, I traveled a lot this year, and I don't remember really seeing many empty seats at all. I mean, these planes are
At
just
on
totally
any
jammed full of people.
on any flight,
Yeah,
full, right?
international, back and forth to Philly.
Yeah.
Um,
So
Crazy time.
it's just kind of a good like pulse, yeah, pulse
People
check on
spending
the
money.
economy. Exactly.
Yeah.
We talked a lot about valuations, and we talked a lot about, how companies are earning a lot of money and we're paying a premium for them in the markets. And I wanted to end with three real world impacts of why that could potentially be. And I've been on record as being very bullish on artificial intelligence. I really think it's going to change everything, about how our economy operates. And we're starting to see actual, very real impacts on companies generating real earnings. So this is not like, esoteric, like, oh, this type of thing will happen maybe, and companies are looking at it and they're integrating. Like, no, this is real, like bottom line stuff. So this first one is pretty cool. So this is from Psychology Today,
Well, this is
and just
great.
and just shows that large language models, so a custom large language model called Brain GPT, that was loaded with hundreds of journals published from 2002 to 2022 in neuroscience, had a much higher accuracy rate at predicting results than human experts, and by a significant margin, right? 81.4 to 63.4, significantly better than these human experts. And what that means is that it's not going to get rid of the experts, but it's going to make those experts so much better at what they do. It's going to make them so much more
And it looks
productive.
like there's a lot of room for improvement. I guess what I'm surprised about is the
Right.
experts only have a 63%. It's like that's a D. That's a D minus in the world of great. It's not very good.
Yeah, predicting study results. But it's going to be able to indicate, which pathways that these neuroscience experts should go down, right? So if you have, right, there's only a certain amount of resources, there's only a certain amount of time, and a lot of times when you're doing scientific studies, there might be 10 different things that you want to try, and the impact of AI is going to be able to pinpoint the three that you should go at, right? Hey, these three things, these three avenues are the ones that we should pursue rather than having human experts trying to pick it out. So this is just in neuroscience. Now extrapolate that to material science, to bioscience, to medicine, to pharmaceuticals, to everything you can think of, right? About where to spend capital, resources, and time. AI is going to make that better and more productive. And this is a real instance of it happening today, right? We're not waiting on it to happen, right? This is happening now. So really interesting stuff. The second one is taking that same concept to energy. And this is from a Barron's article, just showing how AI is making energy production so much more productive, and enabling these energy drillers to find, extract, and produce oil at much lower costs. And in the Permian Basin, which is kind of the largest source of oil production in Texas and New Mexico. The break-even price for producers has fallen to $40 a barrel from 90 in 2012. So, a halving of cost to produce a barrel in the last 12 years, and this is significantly increasing. Kind of the one of the points in the article is saying that this is accelerating. Like we're not reaching a point where we're like at the maximum cost savings per barrel. Like no, this is getting better, and we're producing more cheaper by using artificial intelligence. And so, you look at energy stock prices and energy company prices, and you're like, oh, we're paying this PE for these things. We're paying a price to earnings ratio for them, and potentially, this is one of the reasons why. So I love this. Past decade, the U.S. pumped out 60% more oil a day with 40% fewer workers. Amazing.
Incredible.
And this final one,
That's a great example. I remember, yeah, that's a really great example.
and this final one blew my mind. And this is kind of what more you think about when you think about AI, to think about coding. And this is from Andy Jassy. I might have even mentioned this before, but it's so amazing that I want to bring it up again. And so this is Andy Jassy, the CEO of Amazon, who is not a bombastic guy. This is not Elon Musk, who, not to take any away from Elon, but Elon makes wild claims. He's like, oh, we're going to, have this thing by this date, and we're gonna have self-driving by the here, right? Like, so
Colonize Mars.
Yeah, I mean, and look, he is delivering on a lot of that stuff, but he does say a lot of claims. Andy Jassy is not that guy, right? When he says something, he's a much more conservative type of traditional CEO. And they implemented this AI developer assistant essentially, and he noted that the average time to upgrade a particular application to a new version of Java and code dropped from 50 developer days to just a few hours. But what was really crazy is that throughout the entire Amazon ecosystem, this code kind of co-pilot that's able to go through and scrub code, fix bugs, and take the kind of grunt work away from their good developers, that then their good developers can go work on adding different features and expanding the code base, has saved Amazon the equivalent of 4,500 developer years of work. Years.
Crazy.
4,500 developer years of work. And that 80% of those generated code reviews were shipped without additional changes, right? So 4 out of 5 don't need human intervention, and provided $260 million in annualized efficiency this year. So that's real money to the bottom line of Amazon shareholders. That's falling right to profits. And so this is kind of what we're talking about. And my opinion is that we're in the first inning of this. Like, this is the very beginning of what this is going to mean and do for companies and for our economy, and why we're starting to pay a premium, as shareholders, to access this stuff. So positive.
So you don't think it's too late to access the AI wave?
Not even close. I think it is going to be, when you talk about rising tide lifting all boats, I think this is the ultimate rising tide lifting all boats. I personally think it's the biggest potential economic change since the industrial age, right? I mean, this is potentially seismic.
So Zach, do you use Holistiplan?
I do.
So, here's an example that for Zach and I both, we use a program called Holistiplan, analyze tax documents for clients to better align tax outcomes and investment outcomes. And it's an amazing tool. It uses AI, right? It uses, scans your IRS documents, and it comes up with, perfect recommendations every time. Not that you have to execute them all, but, much more similar to the example you just used, much higher accuracy than a group of CPAs would come up with. Just automatically peels through the data, gives you your information in 3 minutes of computation instead of 10 hours, 20 hours. I don't know. It's definitely lightening the load for us and helped us offer better services to our friendly and favorite clients.
Yeah, it's exciting stuff, and I think we're going to continue to see these type of real world impacts start to kind of come out in earnings calls, and CEOs mentioning them, and companies saying that they did this thing, and researchers saying that they invented this. One of the biggest areas I'm excited about is really like materials science. the ability to kind of create new compounds and new things that can help with space travel and semiconductors and like all these things that require very complex synthesis of elements. I think that we can really use AI to make some major advancements there. So it's interesting. It's going to something fun to follow.
Yeah, I'm sorry. Just as you say this, there's an article that came out 2 days ago. I heard it on one of the radio podcasts, and it was talking about how this is in psychology today. Maybe you saw this, that AI writes better poetry than humans. I'm trying to scan here to try to see if I can come up, but it was like hands down that, like, T.S. Eliot and his famous poems were, the average layperson enjoyed the AI versions better. So it's not just the hard, data science, it's the soft stuff too. So for
Yeah,
better or worse,
yeah,
folks, Shakespeare, Samuel
for
Butler,
sure.
Lloyd Byron, Walt Whitman, etc. Um, Chose 10 very successful poets. Yeah, there you go. So food for thought, folks. We'll keep you posted here on Finance Footnotes. We'll see you next time.